video today, I'm going to explain an extremely important concept in tax planning. It can help you take a retirement tax spike that you may see, like a Medicare penalty or a myriad of other tax hurdles that you will face in your retirement, and diffuse some of those high rates by essentially spreading those tax rates across a range. Now, this tax strategy alone can help you make better retirement tax decisions and help you avoid some of those future tax spikes moving forward into the future. Let's get into it. Now, to explain this concept of spreading out your tax liability, I'm going to use 3 examples of tax hurdles that retirees often face. Let's start with a very common tax rate spike that retirees often see, and that's a Medicare penalty. So if you're not familiar with the Medicare system, if you show too much income at any point while you're on Medicare, you may owe a Medicare premium increase on both Part B as well as Part D premiums. This is due to something called IRMAA. IRMAA can be fairly confusing because it's based off your AGI, it's not your taxable income, and it's a 2-year look back. So what you show for income in 2022 will affect what you pay for Medicare in 2024. Well, with a 2-year look back, IRMAA can be quite confusing and difficult to navigate because we don't actually yet know the 2024 IRMAA thresholds, and yet we need to plan for them this year. Now, in the big picture, understanding where these IRMAA zones fall relative to your normal tax brackets is extremely important. We would think that these IRMAA zones would at least match up with the tax brackets, at least somewhat, but unfortunately that's not the case. Now, as you can see on the screen, the first IRMAA threshold falls right underneath the top of the 22% bracket, so right underneath the start of the 24% bracket. From there, we see 3 additional IRMAA thresholds fall within that 24% bracket. Now, it's important to understand that IRMAA is what we would call a tax cliff, meaning that once you go over a given threshold, it doesn't matter if you clear that threshold by $1 or $1,000, you will owe the full penalty for clearing that threshold. And here's where this idea of diffusing tax rate spikes comes in. So let's say that this couple had an RMD that pushed them just above that IRMAA threshold, maybe a couple dollars, couple $1,000. Well, ideally what they want to do is they want to use the rest of that threshold zone, ideally with the form of something like a Roth conversion. And they want to fully use that zone because they won't be subject to any additional Medicare penalties within that zone because they've already passed that tax cliff. So let's look at an example to see exactly what this looks like in practice. So in this example, we have Karen and we have Randy. Now they both just turned 72, and between their Social Security income, their pension income, and an additional RMD that they are forced to take, they find themselves about $2,400 right above the second IRMAA threshold zone. Now note here that I'm going to be using 2022 IRMAA brackets and applying this to 2020 tax returns. So we're assuming this situation happened in 2020. The reason I'm doing this is purely for the clarity of the numbers that we're using because all of the tax rates and IRMAA thresholds right now are known for 2022, looking back at 2020 numbers. You can simply take the core of this idea and apply this to this year's income as well as future years worth of income as well. So Karen and Randy find themselves $2,400 above the second threshold zone. Now, the problem that they face is the marginal tax rate that they're paying on the extra $2,400 worth of income that they had because of that RMD is extremely high. Their marginal rate is actually 146% approximately. And this is because they're paying 24% in federal income taxes on that $2,400 based on where they fall within the normal income brackets. But they're also owing an extra Medicare penalty of $2,923. So when we add both of these together, they're essentially owing more in penalties than they are taking additional income within this threshold zone. So here's what Karen and Randy can do about this. They can basically max out the IRMAA threshold that they already find themselves in. So moving up to the next IRMAA threshold zone, essentially they can bring their income up to $284,000. Now, ideally, they'd fill in with additional income in the form of a Roth conversion. Now, by using this whole IRMAA zone, they can essentially fill in $56,000 within this zone. Now, they've already filled in $2,400, but essentially what this will do is this will take that marginal tax rate on the additional money within this zone from 146% down to only 29%. So something like an almost $54,000 conversion will do a great job in minimizing RMDs, ideally lowering them by more than $2,400 and thus avoiding this IRMAA zone moving forward into the future. Now let's take a look at another example using the Social Security Tax Torpedo. So we've talked a lot about this tax torpedo on our Safeguard Wealth Management YouTube channel, but if you're a new viewer or you fully don't understand what this tax torpedo is, essentially, big picture how this is created is the amount of your Social Security benefit that ultimately is taxed is determined by your other taxable income. That given income will force more of your Social Security benefit into being taxed. Now, there's 2 zones that you ultimately have to worry about, the 50% zone and the 85% zone. So a dollar from, let's say, tax deferred accounts can force 50 cents or 85 cents of your Social Security benefit into now being taxed. And so there's essentially a double taxation effect that happens here. A dollar worth of income forces a $1.50 or a $1.85 into being taxed. So here's an example of what this looks like for a specific retiree. On the screen, you'll see a graph of this Social Security Tax Torpedo. The red line is intuitively what they think they're being taxed on. Notice it goes 10, 12, 22%. The blue line is their marginal tax rate underneath this Social Security Tax Torpedo. You'll notice that it goes 18.5%, 22.2%, and then the marginal spike zone that we see here of 40.7%. Now, this is under the current 2022 tax brackets. But it's also important to note that unfortunately this tax graph gets a lot worse once the Tax Cuts and Jobs Act expires in 2025. And so in 2026, we see that this tax graph has additional marginal spike zones. We see that the 15% bracket turns into 27.75%, and then again, the start of the 25% bracket turns into 46.25%. Now let's go back to the current tax torpedo graph. Now this specific retiree finds themselves in the middle of the 40.7% zone because of an RMD. This means that the last dollars that they were forced to take was taxed at 40.7%, but it also means any additional income will be taxed at 40.7% as well. Now, once again, the objective of this retiree should be to take that tax rate spike, take additional income, and spread that tax rate spike out across additional income. Now, for this specific retiree, this might mean spreading this out and maxing out the 22% bracket. Well, maybe not fully maxing out the 22% bracket because, again, remember there's an IRMAA threshold that falls right below the 22% bracket. But the idea here is they are taking additional income and spreading out the tax liability of that tax rate spike across that additional income. Now, why does this help greatly? Well, let's take a very bad example of taking additional income. Let's say that this couple simply went right to the end of that 40.7% spike. They would fill in approximately $8,000 of additional income, but they would owe about $3,250 of additional tax liability. Now, note that I'm rounding here just for simplicity, but we see that they're owing a very large tax liability for a very small amount of additional income that they're taking. But if we use the concept of taking that tax liability and spreading it out across additional income, they would be able to Roth convert approximately an additional $60,000 worth of income. Now, the tax liability for the additional $60,000 conversion would be relatively high for the first amount that they would be converting. Again, they would be taxed at 40.7%, but then thereafter they would be taxed at just 22%. Now, the total effective tax rate on that Roth conversion would actually only be 24.4%. So just to reiterate, why would someone do this? Well, with the additional Roth conversion, they will be lowering tax deferred balances moving forward into the future. They'll then be lowering RMDs. Now, this makes sense based on the current tax rates that we're seeing because the idea is they're hopefully going to be able to avoid that tax spike moving forward into the future. The final tax rate spike zone that we're going to talk about is one that's created due to capital gains within your taxable account. This is called the capital gain bump zone. Now, in order to understand how this zone is created, it's important to understand how your income stacks in the eyes of the IRS. So on the foundation, you have your guaranteed income, Social Security income, pension income. From there, as you fill in with normally taxed, tax-deferred withdrawals, you have that fills in that middle zone. Now, what stacks on last would be your capital gains. Now, with long-term capital gains, you have different tax rates that you may be subject to. And what tax rate you're subject to depends on how much income you have before you stack on long-term capital gains last. And so certain retirees may be in the 0% zone, while certain retirees may be pushed up into the 15% zone. And this is exactly how this capital gain bump zone is created. The capital gain bump zone is basically when you go from being in the 0% bracket for your long-term capital gains, but then you show additional income, let's say in the form of RMDs, and those RMDs fill in the middle part of that tax base and push your long-term capital gains to be taxed at 15%. And so what's happening in this capital gain bump zone is you're taking a dollar from, let's say, an RMD. That dollar is being taxed at 12%. But because you're taking additional dollars from RMDs, it's pushing your long-term capital gains from being taxed at 0% to being taxed at 15%. So a dollar from an RMD is taxed at 12%, but also forces a dollar from your long-term capital gains to be taxed at 15%. And so that dollar of extra RMD forces a marginal tax rate of 27%. And it's very important to understand that the size of this zone will depend on how much you have in long-term capital gains. So if we just have $3,000 in long-term capital gains, it will be much smaller than if we have, let's say, $12,000 in long-term capital gains. Once again, this idea of spreading out the tax liability within this bump zone is very similar to the last two examples that we talked about. Many retirees will find themselves in a position where if they fill in with additional income in the form of something like a Roth conversion, they can avoid whatever forced them to be taxed in this capital gain bump zone. Now, I want to pause here and make sure that we understand a very important critical takeaway. How much you actually fill in with additional income, how much you actually spread that tax liability over, will make the world of difference. So we've talked a lot about a max the bracket technique. But for many retirees, they will find that either a smaller Roth conversion or a much larger Roth conversion can make a lot more sense in their situation. So ultimately, how much you should fill in with additional income and spread out that tax liability will come down to three core factors. The first factor is what is causing you to be pushed into that tax rate spike zone. If it's a required minimum distribution, then it is very likely that you will find that filling in with additional income makes a lot of sense. Now, if you just found yourself in a given spike zone because you miswithdrew some of your retirement accounts, and you can avoid that in the future simply by having a better withdrawal strategy, well, then you might not even need to fill in with additional income. The second key factor or question that you need to ask yourself is what will your situation look like moving forward into the future? And this kind of comes back to having a forward-looking tax plan. You need to know if this is a temporary problem or if this is a problem that you will face going forward into the future. And then the third key factor to consider here is what will be the tax rate of filling in with additional income. Now, this is going to be one where you need to probably look at a couple different zones. If I fill in with $20,000 of additional income in the form of a Roth conversion, what will my tax rate be? If I fill in with $40,000 or $60,000, at each of these given points, you need to understand what your current tax rate is to know if it makes sense to pay that tax rate in order to avoid a higher tax rate moving forward into the future. Now, depending on your situation, answering these three questions and assessing these three key factors may be very difficult. For this reason, we recommend using experienced help. If you're interested, our team here at Safeguard Wealth Management can be that help that you need. Now, in this video, we covered three tax rate spike zones that many retirees often face, but this certainly isn't all-encompassing. The important concept here is understanding that taking a tax rate spike and spreading it across additional income can make a lot of sense in order to set yourself up for a more tax-efficient future. Never take a penalty or find yourself in one of these spike zones and simply sit on your hands. You always want to be assessing your situation and looking at how you can turn a bad situation into a better situation for the future. Now, as we talk about these tax spike zones, it can feel like a lot to juggle. At every additional level of income that we take, we need to be thinking about the additional tax liability that we're incurring. Now, in this video, we talked about two specific tax spike zones, the Social Security Tax Torpedo, as well as the capital gain bump zone. And not to overwhelm you or throw any additional complexity your way, but these two tax zones can actually stack on one another and spike your marginal rate as high as 49.95%. Now, if you're brave enough to dive into this additional complexity, we've recorded a video on this exact topic that fully explains how this occurs and how you can avoid this moving forward into the future. This is an extremely high tax zone that you might face and one that you obviously want to avoid. This video walks through step by step how that's possible. Thanks for watching, and always remember, you don't need more money, you need a better plan.